The Nasdaq, as of today, on course for its worst week since April, with this pressure on tech stocks continuing. Of course, we would normally have got the jobs report today, but there's this data drought because of the U.S. government shutdown. Let's get perspective here from Drew Pettit, Director of U.S. Equity Strategy at Citi. Drew, great to see you once again. Thanks for joining us. Talk to us about this weakness in tech stocks. I mean, nothing goes up forever. What is your feeling? Is it just a normal blip in the market?
I would say so. Look, the longer run fundamentals are still intact. We were priced for great and earnings have been good. So when you get that set up, it gives people a reason to take some profits, take some money off the table. And that's what we're seeing right here. And honestly, this is what we expected coming into earnings season. We still like tech, we still like growth, and you're getting a chance to buy it on a pullback right now.
What is, maybe we'll put up a 1 month chart for the NASDAQ 100. What do you think? Is it just normal people just thinking, well, I've made a lot of these tech stocks and taking a second look?
Yeah, so when you really think about this, so I'm going to break this down. So markets are pricing in, let's call it 20% growth for the next 3 years for a lot of these tech stocks. And that's, again, compounding 20% on 20% on 20%. So when you get results that confirm that, not move that number higher, you're fairly valued. So in that instance, when you've seen these big pops, okay, a good normal behavior is let me book some profits. So what we're seeing is people are very excited about these stocks. They're very excited about AI, technology developments, and productivity. But the prices have really run ahead of what the fundamental trajectories can support. So when you get that set up, healthy behavior is taking profits like what we're seeing now. Unhealthy behavior is levering up and keep chasing these things higher and higher. So to us, you want these types of volatility events when you're in a bull market so it can be sustained longer than just a month or two.
This is an interesting analysis tool that you use. You've been checking out retail investors' use of leveraged and inverse ETFs, which are typically seen as short-term trading vehicles. What trends are emerging?
So a lot of people are going to focus just on the level of assets in leverage products over inverse products. So with the market up, yes, leverage products, anything with upside or added upside is going to have a lot more money in it. But when you look at the use of these products, so, okay, they're long, people are happy, they feel good, they've made a bunch of money, but when you get big moves to the upside, they're actually selling these leveraged ETFs. And the other thing, they're not holding on to them. So the average holding period, our guess, is about 4 days. So again, that's pretty good and smart tactical use. I'm going to hold it for a short period of time. I'm going to sell it when I get a pop. So those types of behaviors, as long as they stay in place, again, that's healthy. That's not irrational. That's not performance chasing. That's not exuberance. Throw in your qualifier, whatever it is. We're not there yet. Again, healthy behavior is what we want to see. Pullbacks aren't bad.
And broadly, what asset classes are you emphasizing right now, or what types of stocks?
Yeah, so it's funny. We do like NASDAQ on pullbacks. If you were sitting on money thinking about putting it into the U.S., small cap is a really interesting place. That's where you actually will have positive earnings growth next year for the first time in 2 years. So new money, put it to work in small cap. The money you have kind of sitting around, I would say just kind of earmarked for equity allocations. You can buy growth on a pullback. And then kind of within growth, we like GARP approaches, so growth at a reasonable price. And within small cap and cyclicals, we want to buy companies whose quality is set to improve next year. So those inflections in earnings growth and improving margins.
We hear often, I know, I mean, it's an axiom for some investors, I mean, and could be questioned, but small caps tend to be more exposed to the state of the U.S. economy, the domestic economy. So do you feel okay about the state of American growth?
Yeah, we actually do. It's funny, to us, you're going to have some softening in employment numbers. Some of the non-government data that's come out has kind of told you two different stories this week. But if you avoid recession, you probably have enough of a tailwind coming off of uncertainty this year in trade to actually inflect earnings growth from negative to positive for a lot of the cyclicals. Now, that's something you haven't had in a long time. And just to kind of be cheeky with this, the reason you buy small cap stocks is for growth. You want those things to have growing earnings, and they haven't for 2 years, and they will now. So it's not going to be an all-in market if you think this bull market is going to continue, and that's honestly our base case. There's more things that could work into 2026.
You have a couple of stock ideas for us. One of the companies we don't talk much about, MKS Incorporated, MKSI. They're a tech company. They supply instruments, also chemical products used in semiconductor manufacturing. And you see promise in a name like that?
Yeah, it's funny. Everyone wants to talk about the NVIDIAs and a lot of the big cap semiconductor names. And yes, the fundamentals there are strong, but you're starting to see a broadening out in tech. So semiconductors has been an area that we like. We like the fundamental trajectories. Where you actually get better value in kind of AI and growth at a reasonable price is when you move down cap into some of these names. So the trade's broadening out. The fundamentals are strong here. And you should get more upside when the revisions move higher in a name like this.
Another name, Mastech, MTZ. It's an American infrastructure company, and they're involved partly in the big build-out of electricity.
Yeah, I'll stay away from the thematic story here. You covered it really well, Andrew. When you look at the fundamentals of this company, it is expected to see margins improve into next year and the year after, and you're going to see its asset turnover pick up as well. So its efficiency is getting better. So when we talk about cyclicals, we want improving quality, and here's a company that's doing it, and a company that's expected to keep doing it. So these are the types of inflections that we want to buy into for 2026.
We'd better jump. Thank you very much indeed. Really appreciate it.
You're welcome. Take care.
Drew Pettit, Director of U.S. Equity Strategy at Citi.